Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. What's going on, everybody? Welcome back to another episode of the Roundup edition of Forward Guidance. The boys are back. We got the trio. What's going on, guys? How's your week?
It's good. I'm up in New York City. I have a Anthony Pompliano and Reflexivity Research's crypto investor today. So doing a panel at 3:50 p.m. I guess when everyone hears this, it'll be over. But
nice. My old stomping grounds.
That's yeah, I saw Will last night. Saw the crew. Good guys.
That's awesome.
Are you going with the shaggy hair, like, I don't know, 90s grunge look? What is this?
No, I just had to work it this morning. I'll clean up right after this. Busy day. I had breakfast meetings. I'm running around town.
You gotta raise that money. Gotta hustle. Gotta get the PR out there, man. Appreciate it.
On my life, you guys might enjoy this. You're probably a little far away from this, but I have a 6-year-old, a 4-year-old, and a 2-year-old. And the 2-year-old is just not sleeping. He wakes up in the middle of the night from 2 to 4:30, like screaming bloody murder. And he gets so worked up that he vomits. So we're like, he literally does it. So you come in and lay with him. And there's all these sleep people that are like, just let him be. And he's like making all these noises, like he's choking. It's crazy. Anyway,
Dude, kids are crazy.
Man.
This is what you have to look forward to. This is why I look like I'm, so
When's losing sleep over building a fund? You're losing sleep because your child's crying wolf and puking.
Yeah. Well, that's my life. Just a snapshot.
Love it. Okay, I want to talk about what's been going on for the last couple of weeks in rates, because it has been a bit of a whipsaw, and we've been mostly on the right side of things on what we've been talking about for the last weeks, but this is just a great chart just to set the stage of just like everywhere that we've been. So this is just looking at the implied Fed funds rate based on the 30-day futures. So it's basically just showing the path of rates over the next few years and where the terminal rate basically bottoms out. So you can see currently we are the blue line, which is actually above the post-Jackson Hole expectations, which is basically like the ultimate, inflation mission accomplished type idea that Powell, started to push out and saying, all right, cuts are coming. Here we go, game on. So what's interesting is that we're above that, and we're significantly above where we were around mid-September, around the first 50 bips cut. That was, some of the most aggressive rate cutting expectations that we've seen in markets. So it was very, very aggressive. And what I find really interesting now is, based on this and looking at where we're at, this is just a great chart just showing the comparison between the 3-month term SOFR, which is just basically what I just showed on the last chart, that blue line, just overlaid with the Fed median dot plot forecast from the last meeting. So this is really interesting that there's two things here that I'm seeing. One is that if you looked at this chart, I don't know, 3 weeks ago, you would have seen that the dots would have been significantly above the straight line curve, the SOFR curve. So the market was pricing in a lot more cuts than the Fed dot plot. But now you can see is that we're pretty much like right on the money here, at least until we get to the terminal rate. The terminal rate between the Fed dot plots and the market expectation is different now, though. So the Fed is still at like that roughly 2.9%, whereas the market has it higher at about like 3.3%. So we've sort of been through this ringer, this whipsaw over the last month and a half or so, and that's had some pretty big effects on currencies and yields as well. So we've seen the long bond yields increase quite significantly. Where are we at right now? We're seeing the 30 years at 4.46, whereas even just a month ago we were at 3.9. So it's been a pretty big move. Quinn, what are you seeing? Let's start off with you. Just what's your perspective on where rates have been and where they are now and where you see them headed from here?
Yeah, so I've been I've been in the bond bear camp. Was lucky enough to also have, similar to Druck, put on the short long duration trade when the Fed did 50. And I've taken that off quite a bit. I think the move is fair now. I think it was a swift move. But if you look at that like 10-year chart, 30-year chart, it's basically like we just recovered this range. That was a false breakdown on these just extreme recession hysteria fears, which we were combating for a long time. And so, there's a number of places to look that in the market outside of the bond market that show this was a growth re-rating and not an inflationary real rate scare. And that's why I've continued to remain very bullish and think that ascension in rates, and therefore what was kind of sending the dollar way higher, is overdone. And an example of that is oil. Oil is still absolutely tame. And if you look back at every real rate induced risk off scare in the last 3 years, it was due to inflation. And oil was, a sign of that. So very big signal there. And the stock market has held up extremely well despite this rapid rise in the dollar and yields. That means it's a growth induced re-rating higher. And then the last point I would just say is around the Fed expectations of forward guidance and forward rate cuts. The biggest bear case, right, for the last 3 months since the summer was, oh my God, the market is way over its skis on rate cut expectations. What's going to happen when that gets priced out of the market? Well, what happened is stocks are still at all-time highs, and we just took all of it out of the market. Because personally, I think I think for sure 25 in November. I think a very good chance of 25 in December, and then I think you kind of reassess and maybe pause a little there. Maybe December gets taken off if the data starts coming in really hot. But as we mentioned, there's hurricanes and election data and things that might make it a little wonky, and reasons the Fed might still want to pursue on that 25 in December. But the key takeaway for me is the forward Fed cut expectations are the most fair they've been in many, many months, probably quarters, like even more fair than to start the year. So, that risk is gone to me of like this uber hawkish Fed, because I think, they've made it clear they're in the easing cycle, and how quick they go is just, data dependent or forward guidance dependent, more like it. So like these, I expect yields to continue moving higher over time. And I think absolutely hate the long bond, because I think the economy is going to get hot. But that's for great reasons. That's not.
Quinn, I just want to show, I just put this chart together on TradingView just to show what you're talking about. It's just looking at like the 30-year versus oil. So you can see this dislocation that Quinn is talking about, where, yields and oil track pretty tightly in terms of correlation. But you can see over the last couple of weeks, we've seen this dislocation where the pink line is the 30-year yield, and that's risen significantly, whereas oil has just basically chopped around. It's sort of still at the bottom of its range. So this is what Quinn's talking about when he's saying that there's been this weird dislocation. And maybe we can chat a little bit about why we think that's driving it. Obviously there's been this growth rating, but it feels like everybody has their own reason for what's been driving this lately.
Yeah. And the other key point I would make is that this is not a Druck and PJT and everybody went on, and this short long bond trade got extremely loud. And I think it's the right one over a 12 to 15 month time horizon. But obviously, once you start hearing about things, it's becoming consensus, and everyone then starts talking, I think there's going to be problems with the debt burden and all these things. And I'm like, yeah, well, if foreigners said, I can't trust the US government anymore, they're way too indebted, the dollar wouldn't be screaming higher. You'd be getting a sell-off like you had in the UK with the gilt crisis. So whatever issues, everybody needs to keep in mind, whatever issues we have in the US with our fiscal situation, which are real, in my opinion. Bank of Canada just did 50. ECB's talking about another 50. Japan stopped cutting. China's going full bore. So like, that cleanest dirty shirt is still very much the case. And in some respects, that's the bull case for US risk assets. So
we can talk a little bit later about what Druckenmiller and Paul Tudor Jones are doing there. We can entertain the deficit doomer ideas and give them a little love in a bit. But Tyler, I want to get your take on the rates complex, what you're seeing there.
Well, first off, some market actions are always fascinating is when you see back to back Paul Tudor Jones and Druck saying, number one, I don't own bonds and I'm 20% short in my book on bonds. I saw these moronic hedge funds run and they chased the trade, and I saw put spreads galore on HYG, on TLT at the exact time. It's just like, it's the most fascinating thing on the herd mentality, and they always do it in a structure that is the
Yeah.
worst. So
Yeah.
I saw that for 2 days right after they made those comments, and now I'm seeing kind of those things unwind a bit. I think they're a bit stretched, and if you look at the FX, maybe you probably go through some of these charts, but
Yeah. Let's do it.
maybe slide 20 is a good one to start. We'll start with the FX and then talk about rates. This is the euro. Last couple of days, the euro touched 26 on the RSI. This is the lower screen, the relative strength indicator. And the euro was going down basically because Trump's odds were going up. Everyone's talking about tariffs on the euro and they're lowering rates, et cetera. And now that feels a little bit overdone. So when the euro rallies, it gets stronger, the US dollar sells off. Then go to slide 21. This is the euro on a MACD basis. The MACD is the lower chart. And this is momentum. That looks to be possibly turning up here as well, which would indicate a weaker US dollar. Then if you go to slide 22, this is the yen that we were talking about. The RSI is a bit stretched there, 66. And if the yen gets stronger, that's another weak dollar indicator. And then go to 23. This is the CAD. Looks like the MACD is rolling over. If the CAD rolls over, this means the CAD is strengthening relative to the dollar, meaning a weaker dollar. What I'm trying to paint the picture of is all these other currencies are pretty overdone in terms of sentiment. You could just the risk reward. And then if you go to the next, this is the dollar index, the next chart, you'll see the momentum, the MACD on the DXY is actually turning over here too. So, and you're heading into Trump. Obviously, he's probably a weak dollar policy and the dollar's been super strong. We could get into an odd world where rates go lower, dollar goes lower, and Trump wins the election. That's what it's looking like, at least the betting markets. But what I really wanted to talk about was the implied vol, because people were buying a lot of protection on the fixed income market. So this is slide 25. This is just a great chart. And this is classic election. Let's protect our book. So this is a chart of the move index versus the 1 month realized volatility, which is the purple, and the move is let's call it blue. And so 1 month realized volatility is basically how volatile treasuries are on an actual historical price basis in the past. The move index is, the future volatility of treasuries. You had Harley Bassman on talking about this recently, Felix. But when the spread, so this is the implied is the future, and the realized is the past. When the spread of this is wide, it basically is saying the market is portending a larger move in rates than the actual historical prices are telling you. And either one of two things has to happen. The realized vol has to go up, or the implied vol goes down. So that blue line would collapse potentially. So I think if you look at this, and then here's the next chart. So this is the fixed income market saying people are betting on a wide range of outcomes. This is the equity market. So the UX1 is the VIX futures. That is the white line. And then the S&P historical vol for the past 20 days. This is the past 20 days of volatility on the S&P. When there's a large spread between the two, that means people are paying up for protection. So if you look at that spread on the bottom, which is the bottom ratio, this is the difference between the futures, the UX1 VIX futures, and the actual realized price. So you can see it's stretched. It's in the 81st percentile, meaning it's very expensive to where actual prices are trading in a pretty tight range, but everyone's betting on the future because of the election. So
Yeah.
what I'm trying to paint the picture of is everyone's hedging their book in the election like something crazy is going to happen. And the event risk, if it passes and there's an actual solution where somebody actually wins the election, it's probably to come smashing down. If it doesn't, the
Hmm.
case of where we don't get any conclusive evidence of the election, then things could get a little bit hairy. But we're
Yeah.
also in the giant buyback period at that point after earnings. So
Yeah. Tyler, this thing that you're bringing up here, this spread between realized vol and implied vol, I think is one of the most important components of markets right now.
yeah,
Like, and I think that's the key. So if translating that into like regular speak of what's going on here is that if you're like, okay, the election's in a few weeks, I need to buy some protection because I don't know what's going to happen. Well, the problem is that it's already too late. Like implied
yes.
volatilities are already juiced. So, you're buying, you're basically top blasting the high of implied vol. It's already juiced in there. So you need to have an even greater event risk than what is already priced into the markets. And like Tyler's showing here, it's already at very extreme levels.
And the easy way to articulate this is implied volatility is basically insurance. And so this is like watching a hurricane come. Say you live in Florida and you see a hurricane off the coast, and you rush to buy insurance on your house, and everyone's buying insurance on your house at the same time, and then the hurricane turns out to be less bad than you thought, then that insurance basically becomes worthless. So
Yeah.
that's the whole principle here. And I guess my read is that the hurricane will probably be less bad than we think, but there's always the chance.
It very often is, and this actually ties up nicely because I wanted to talk and explain this week as well, because there's been a lot of charts showing this move index breaking up higher, and I've seen some takes where people think that bond volatility is going up and the Fed's losing control of the bond market. So as Tyler mentioned a couple of weeks ago, we had the actual creator of the move index on the show, Harley Bassman, and he also actually shared an article a couple of days ago mechanically breaking down how the move index is created, and then how that actually shows that you can actually see the premium baked into the implied vol that Tyler's talking about. So I just want to go through a couple notes here. And I'm going to make sure I do this right by actually bringing up the notes here so that I don't mess up Harley's work. So, okay, the move index is basically an annualized implied volatility for 1 month options across the yield curve. So a move of 100 indicates a 68% chance that 1 year from today, interest rates will be within 100 bips of the current rate. So it's the standard deviation, basically. So then to estimate a 1 day rate change, you can divide the move by 15.9 because there's 252 trading days per year, and you can get the daily implied moves. So then the move calculation is actually rolling on a daily basis. So as basically, let me make sure I got this right here, is that as a new trading day comes into that 30-day window that we're talking about of the move index, the front day basically comes out here. So as we start to get in these highly juiced event risk days like the election, the move index is going to naturally just dislocate up higher just because of the juiced up implied volatility that Tyler just showed in the other charts here. So what you can do from that is that, and this is what Harley did here on this slide here, is you can actually calculate what is the risk premium baked into the move index because of a certain event risk. So here he did this with every election of the past 30 years or so. And you can see basically what would be the move index without the election vol and with the election premium. So, and what you can see here is that aside from 2020, which he basically dismissed because what happened there is that there was still a significant amount of COVID crash premium baked into rate vol. So he's like, okay, ignore that one. There's some weird, COVID crash idiosyncratic stuff going on. But if you look at the rest here at the bottom there, we're at a 24% premium in the move index. And then you look at, some other recent elections like 2016, which is the one where everybody was like, oh my God, if Trump gets elected, everything's going to go to shit. I got to hedge my books pretty hard. We're only at 1.83%. This time we're at 24%. So just to really hit home here that like the market is extremely hedged right now. Some of the most hedged that we've ever seen. If you look at like just the event vol premium in the move index, it's extremely hedged. If you want to be buying hedges right now for the election, it's too late.
Well, and that's we talked about this last week, but the
Except
VIX
upside
does,
hedges.
Except upside hedges.
yeah. But you're watching, like I watch every day, and the VIX bleeds lower every single day now because everyone's sitting on time decay and nothing's really happening. You have some earnings going off, and it just turned out that Tesla's was way better than expected, and that event risk rolls off. So you're sitting on just you're watching the hurricane come, and there's no additional information, and every day that goes by, your premiums bleed. So I think that's sort of the phenomenon why the market's grinding up here, and everyone's confounded. What the hell is going on? Yeah,
Quinn, on that note, so obviously, we're getting in here and talking about this inevitable election that's coming up here soon, and it's all about looking at like the distribution of possible outcomes. You had some interesting thoughts in your recent investment letter that would be great to hear you talk a little bit more about here in terms of what you're seeing and how you're playing this.
So I basically, and for all the quants or math guys out there, don't make fun of my very sophisticated drawings here. But I think the thing that people are maybe not talking about enough is this idea of the probability distributions, the conditional probability distributions. If Trump wins this, if Kamala wins this, and then it's those two realities that go into the aggregate probability distribution. And so you really have to kind of boil down those two. And what they are generally speaking, the odds of a Kamala of blue sweep are very, very low if she does win. But so that kind of points towards status quo, not a ton changing, not getting unrealized cap gains tax through, not getting any sweeping kind of more liberal economic policies through. On the other hand, you have, if Trump wins, a very high degree likelihood of a red sweep, just given where Senate and House members up for reelection, those jurisdictions, etc. So knowing that, if Trump wins, the right tail distribution of extending tax cuts, infrastructure, whatever it is, which is a very deregulating financial services, changing the SEC heads, all these things, very, very pro growth in a very fat right tail. So you can even, what I would argue is, I would argue that most market practitioners are not, and this is where I think a lot of people getting this analysis wrong, like Trump trade being priced in, Trump trade being priced in. It is true, but I would say more so true because if he does win, the upside convexity of getting a red sweep and moving these things through is much higher than if she wins. It's more just status quo. And so you need to price in ahead of the election, which is this aggregate. On the next slide, I kind of break this down in just more numbers terms, which is like, you can see this, right? The markets are really great and good, more likely under a Trump win, and they're just kind of the same, okay, under her win. And even if they're 50-50, that skews the right tail. And it doesn't mean, just because the market's pricing in the Trump trade, it doesn't mean that the market's thinking, oh, it's a 60-70% chance in winning. It's that you have to be prepared more so for those outcomes and move the skew a little bit that way. And I've been seeing a lot of kind of people will listen to this and say, well, Quinn, you're a young buck, you've only traded through a number of elections, which is true. And I agree that
he does shave.
Yeah,
he actually can grow facial hair, believe it or not.
Like there's this huge taboo around like betting your portfolio on election outcomes. And okay, fine. I think you just like, I'm not one to tell anybody where their edge is in markets. Like there's people that bet on weather and catastrophe bonds on Wall Street. There's people that bet on everything. So like, if you have an edge, I don't think anyone has the right to tell another person where your edge is. But I think people like looking at these market moves and saying like, oh my God, this is so foolish of people to bet on outcomes of the election are missing this point about, it's less that people are saying, oh, I'm going to push this in my whole portfolio because I think Trump's winning. It's saying, well, if he does win, it's a big move I have to capture more of, versus if she wins, it's kind of just like grinding higher status quo, and you need to be positioned accordingly. So that's my take on that. And
so Quinn, like, so we talked about how long bond yields have been surging. You can write, everybody has a different opinion on why that's occurring. Maybe it's just the recession fear trade is being unwound. It's the growth is being better than expected. It's the Fed cutting 50 bips instead of 25, or it's the long bonds are pricing in a Trump sweep, a red sweep. Some people think about that too. So based on these odds, like how priced in do you think that is into the long bond market? Because when I look at it right now, it feels to me like we just saw that pricing in because it happened pretty closely to the same time that Trump's odds really started to skyrocket. So like, let's just say we get a red sweep. What do you think happens to long bond yields? Do we just stay flat, or do you think we go higher from there?
Higher. Yeah. So I think all of the, say, re-rating higher in interest rates without an associated re-rating higher in the good parts of why that is, i.e. growth, is done. So I think interest rates are fair. I think they slightly lean towards, just like everything else for what I just described, because if Trump wins, pro-growth should re-rate higher, and interest rates would be one of those bond yields. So I think there's an element of that in the market. But if he does win, I think there's still a good amount of move left, because I do think the market generally believes it's still fairly toss-up-ish. Maybe it's 60-40, maybe it's 55-45. There's still a good amount of meat on the bones for the move that needs to happen. But if you look at like 2016, that was on the back of good reasons. That was on the back of growth and economic momentum and less financial services regulation, Main Street, economic benefits. So my base case is if he does win, yes, we get yields going higher. The dollar is a weird one because a lot of his policies are oriented towards weak dollar. Although you might get, if the economy really strengthens, you would get maybe a revamping of the U.S. resilience narrative. And so I less views on the dollar, but I don't think it really matters. Looking at fiat pairs when everybody's just flooring stimulus is like less relevant. But I think like Bitcoin, I think energy, probably, I was looking at this morning, that's my probably least priced in Trump trade right now, because under a current status quo, you have US production rolling over, but still a strong economy. And under a Trump trade, you have a pro-growth, needs to get priced in higher demand and less regulation for energy companies. So as of this moment, actually, I think energy and oil commodities are the best, or the least priced in Trump trade. But yeah, generally speaking, I still think there's a big move to be had. But it's just like maybe more grind up, like as the economy improves.
Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show.
Well, it's definitely going to be a grind up because the investor base is all systematic now, and no one ever actually discounts the future. It takes time. Freaking algos and not real humans. But to pivot a little bit, I don't know, Felix, is it okay to talk about Janet Yellen on real interest rates?
Absolutely. I actually might even have a chart for you ready for that one.
I know. This is Andrea Steno Larson, who I call
I got it.
Leonardo DiCaprio of finance. He's got that's his doppelganger. Pre-Diddy. So he had this note out this week. I have a hard and fast rule. This is Janet Yellen speaking. I don't have a hard and fast rule, but I'd like to not see real rates drift above 2%. And this is the chart he had. And he said, nothing is more revealing than a bureaucrat unintentionally exposing the true objectives of fiscal and monetary policy in officialese, making it difficult to grasp the underlying ramifications. Janet Yellen addressed the ballooning interest payments as a percentage of GDP in her interview with Bloomberg on Friday, referring to the real net interest cost of debt as her guiding metric for assessing the sustainability of U.S. debt levels. There are a couple of interesting takeaways from her focus on keeping the real net interest cost of debt below 2%. But first, introducing a real element allows this metric to decline if inflation spikes again, as the real cost of servicing the debt will be inflated away. So this is basically what, this is what I've been talking about for a while, is you have a giant global sovereign debt bubble across the world. All these countries have to do fiscal to inflate away the debt. And they'll probably devalue, dilute their currency bases and keep interest rates lower from their central banks, lower than nominal growth rates, so that they can delever their economies. This is how it always works. It's that book, The Bankers Who Broke the World by Liaquat Ahmed. This is how history always works. And she's saying it overtly now. So I don't get why this is so hard for people to wrap their heads around. You are now in the Ponzi finance part of the cycle.
Yeah. The way I put it is like there's the game and then there's the meta game. And the game is, okay, the Fed wants to have 2% inflation, and it cuts when it gets to there and it hikes when it gets to here. And we see a beautiful business cycle. But then the meta game is what we're talking about here, which is this chart, which is just like, real net interest cost of debt as a percentage of GDP.
Yeah. And so you have to have, this is where you're getting into fourth turning to first turning. If you have a negative real interest rate, people are going to take out so much debt. Valuations are going to get wonky. They might even get wonkier than we've ever seen before, because it's not the same type of finance that everyone thinks it is anymore. And she's saying that overtly. So that's where I am. And then I guess we could talk about, this is slide 28. I don't know if you hit me with that one. Jay Powell's record on inflation has been similar to Arthur Burns. So this is, we see the CPI, the red line CPI from 2010 to 2014. And it goes through the history of the same sort of cycle that Arthur Burns did from 58 to 82. And you see inflation spike. We raised interest rates, and now we're at the point of lowering interest rates. And this is where that second, the 70s inflation came roaring back. It's possible, we get into that world, especially if China's pulling out some fiscal.
We'll see. Maybe I don't know. When I see charts like this comparing us to the 1970s, and it's like, oh, the second spike is coming, I'm a little bit.
I wasn't saying that. I was saying whether it's, we might see that, but look at I put charts on my Twitter yesterday. There's a giant productivity boom going on right now. Yes. I actually didn't put those charts on there, but the amount of output you can get as like one employee is like exponentially better. And especially as these AI things come to fruition, which I am starting to believe it, we're going to see massive productivity enhancing. So like we could have been in this Goldilocks stage here, which would be very first turn.
And so it's super valid to say that what you're saying, that it's possible. I'm definitely not insinuating that you think this is the most like highly likely outcome, and me neither. And that's why like I've been saying this for a few weeks now, that my simple rule to gauge whether this occurs or not is where oil is. If oil is above 100, yes, I'm more concerned about a second wave. If we keep chopping around at 70, I just don't see it happening.
I think these charts hold some weight, but they need to be countered with the fact that all of these big spikes come from like some sort of crisis, geopolitical conflict, war, oil embargo, things like that. But I think you have to be very cognizant. Like the analogy I've been using is like everything's so sanguine on the surface, stocks all-time highs, like every asset, but underneath you have the largest global equity markets moving 10% up and down in matters of days, meaning like all of this, like running the economy hot, stimulating and adding juicing liquidity just sets tons of tinder for if there is one of these events. And the thing, Felix, you've talked about this, you battled some people on Twitter in the past about this, is when we were talking about the Fed's action and their global coordination, people have to remember the green light that Powell gave in just absolutely definitively saying we are entering a cutting cycle in August, and then reaffirming that in September FOMC, is the green light for the global central banks that have been waiting for ages to cut but couldn't do so without sacrificing their currency while the Fed was tight. Now, like, yes, if things start running hot in the US, blatantly obviously hot, the Fed will start to tighten or pull back. They'll pause first, and then, but that's a long, long ways out, because if the Fed just stops cutting while everybody's ripping off 25 and 50 left and right because their economies need it bad, like Europe and Canada. If the Fed just stops, they're tightening. It's all relative. So, relative yield differentials, relative currency pairs. And if they just stop cutting and go to their own higher for longer island, they significantly tighten global financial conditions, which would have
100%.
unintended effects on their goals of supporting the labor market. So people want to Ponzi finance. Yeah, it's centrally coordinated. This isn't independence of any central bank anywhere. It's a concerted effort.
The dynamic of looking at things relatively is so important, and it's what a lot of people miss. Exactly. And I don't think it's a coincidence that the Bank of Canada cut 50 after the Fed gave the green light by going 50 first, and we're seeing the ECB probably going to do that as well in their next meeting about cutting 50 as well. It's not a coincidence that that's happening after the Fed cut 50.
Vol controllers,
Vol control, man.
Yeah, is it a coincidence that the RRP is down 200 plus billion in the last month? There's a big day on November 5th, I think, that would be cool if the Treasury, got reelected.
Andy's gonna have a word with you, Quinn, about that one.
I mean, there's month-end stuff and all this,
Yeah. Okay, but something that we're getting at here is, I think that the dispersion between actually macro trading and then macro ideas, and I think this is something we talked about at the start of the show, where we were talking about Paul Tudor Jones and Stan Druckenmiller coming out onto CNBC and having their in Bloomberg and having their interviews talking about how bad the deficit situation is. Druckenmiller's been talking about this for 20 years now. If he was just short bonds throughout that whole 20-year timeline, he wouldn't be running a family office anymore, right? So it's super, super important, as we've been saying, is piecing apart what are your personal opinions and what are your market, views, and what's actually priced in relative to those opinions. So yes, we had these headlines come in this week of Paul Tudor Jones saying all roads lead to inflation. He's long Bitcoin and gold. He's short bonds. Honestly, pretty similar to my book. Druckenmiller talking about how he's shorting bonds as well. But then to Tyler's point, all the lemmings come in and just chase that trade as well. But again, these are their personal opinions, and it's different from their market execution.
Yes, this is I think the short term, this is probably more of a long-term theme that they're playing out. But I love the short-termism of people buying, 2-week puts on something, and you're like, oh, they're shorted, let's make money. But anyway, I think longer term, I still can't wrap my head around what millennial or Gen Zer is going to buy a bond. The premise of
a certificate of confiscation, you mean?
The only way they're going to buy a bond is if they buy a Vanguard fund that has bond. It's like a 60-40, and they don't even realize they own a bond. That's the only way they're going to buy a bond. And so they all know how ridiculous this is. 7% deficits to the eyes can see. And it's only going to stay that way. I'm sorry. I just don't understand why you would own a bond unless you're a boomer and just want, fixed income. And that's probably the majority of these systematic flows into the fixed income market anyway. They want to lose money.
Yeah. I mean, it brings up the question that people always say, which is just when's QE coming back? And it
never left.
That's fair. That's fair. There's just different versions of it, but somebody's getting stuffed with bonds here.
Yeah. And what I mean by that is, one of the other interesting things is if they issue on the front end of the bond market where the Fed funds rate is more potent, then they don't have to worry about long duration assets, and you can have longer duration. There's no supply of US Treasuries on a longer duration basis. You can manipulate the yield curve. And that's your yield curve control. That's what we're doing here, but I can't say it because if you say it, the con is up.
Yeah.
So
yeah,
it's sort of the world we live in, but people who are super left-brained have a hard time realizing it's a political trade now. It's not.
Yeah. What do you guys think about, so just pairing these two topics that we just covered here, which is, okay, odds of a Trump winner increasing, odds of a red sweep are increasing. There's starting to be rumors, and Quinn already gave me shit on Twitter for talking about this a couple of days ago. But there's chatter more about what the implications are on the long end market, so long bond market of, could we see a Liz Truss moment type of event again? And just for those that don't know what that is that Liz Truss, I think, probably had the shortest tenure of any prime minister in England history. She was basically prime minister for 6 days, provided a budget that was just filled with deficit holes that just basically panicked the gilt bond market. It went no bid. Literally, the Bank of England, a day after saying that they're going to start quantitative tightening, actually had to come in and do a short-term stint of quantitative easing to calm things down. She got booted as prime minister. And they basically had to just come in and cap the long end market. So there's concerns that based on, even a couple Trump policies that or ideas that have been floated around. I saw yesterday that was like, okay, we're gonna use tariffs revenue and take away income taxes. And I know this is just election time. This is just like ridiculous stuff, and this is also just like how Trump plays things. Is he says something big to get something smaller that he wants. So I totally want to respect that idea. But also want to ask you guys, based on this dynamic of, okay, there's a lot of debt. Nobody wants to own bonds. No young person wants to own bonds. At the same time that we're seeing these potential deficit concerns, how valid they are, we can talk about that. But it's creating an environment of concern for that.
Yeah, I get that. Like if that no income tax, but think about what the equity market does in that. It absolutely, it triples. If you have zero income tax or zero tax, like what does that do to productivity in the private sector? And I don't know how that the bond market can completely derail. The great rotation would probably happen from bonds to equities.
That's fair. Okay, so Quinn, prove me wrong on the whole Liz Truss thing, because and it's not my base case either. It's like, I don't know, maybe I moved it from 5% possibility to like 20%.
I just couldn't be more vehemently opposed to almost every regurgitated quote unquote expectation of market effects and policy decisions upon a Trump victory. So Trump's going to be more inflationary. Well, we know inflation is largely driven by energy, and his energy policy is extremely degrees more disinflationary than Kamala. Many points. Obviously the immigration is a thing that is definitely more inflationary than hers. But let's look at what border crossings have done in the last few months as they've been trying to win this election. They've come down a ton. And let's also talk about the one-time rebalancing of the labor market that's already in the rear view. And now the supply-demand balance is much more in queue. So Trump is a guy that wakes up, tweets about S&P 500 and plays golf and talks to business leaders every single day. This guy is not creating people I don't understand how people don't look at his 4 years and they make up these extreme scenarios of what's going to happen, like scare tactics. And when we have 4 years to look at of what he's done, and that's negotiate better with our trade partners, be very markets focused. He has a team of Howard Lutnick, Elon, Vivek, JD Vance. His team is business people. They're not socialists. And so I just disagree. On top of this, let's look at the Fed. Let's look at the Fed potential nominees. Kevin Warsh. I might be getting his name wrong.
You got it right, man.
Versus
Lyle. That's fucking awesome.
Yeah, he understands how this whole Ponzi works. Versus Lyle Brainerd, who might be, if Kamala wins, which would monetize massive debt.
You said 7 words in the past. Vehemently, Lyle Brainerd.
So and then look at exactly, and then you talk about which one side of this election has even remotely proposed getting government spending in order, and that's the Department of Government Efficiency, Doge, with Elon and Lutnick. There's just complete misinformation that's become somehow widely accepted because no one's used their own brains. On top of this, the economy is much stronger, the dollar is rising, and for a Liz Truss moment to happen, like I said, you have to lose faith in the currency too. It's not just the bond market, it's currency.
That's fair.
And look at our problems. Yes, there are plenty, but then look at the global problems, and we're talking about every other central bank still going to do another 50, and it's not even close. So I just
Quinn,
disagree with a lot.
I think I don't know if it's misinformation. I think it's a misconception around how Trump approaches policy, which is that, again, like I was saying, he puts out these big things to get the lower thing that is actually what he wants. And so to your point, like when you're talking about Kevin Warsh, he was on CNBC this week, and every macro, I don't know, idealist that wants to talk about, the Fed returning back to normal and no more ZERP, and these ideas are like, oh my God, like make this guy the Fed governor. He's so bang on. Like, let's get back to the real monetary policy at hand here. And this guy is, like you said, is the front runner to be Trump's, Fed president. And when he was on CNBC, the host asked him, is like, okay, well, you kind of sound like a hawk, but like, does Trump know you're a hawk? Because like you're saying some things that go against like his braggadocious ideas. But I think again, it's a misconception of how he approaches policy.
Yeah, exactly. I mean, so and then the other side, like financial services regulation, very inflationary when you constrict, everything going on there. So I just don't buy into a lot of that, and I try to develop my own views on the subjects, and they happen to be quite opposed. I'm also, like I've said, I'm in the camp that I think the macro is so supportive here that I think people are over hyper focused on the election when things are generally really fine. So I'm an optimist. So despite my leanings towards preference, I think everything's going to be fine.
I want to say one thing on Biden shortly, which we don't give him enough credit. The CHIPS Act. Did you see this thing about Taiwan Semi producing chips in Arizona?
Yeah.
That's pretty awesome. Like that changes.
So what happened, Tyler? I'm just give a little background.
I think they had I don't know. I got to dig more on details. I'm a macro guy here, but basically they had a good yield from the Arizona plant at Taiwan Semi, and they got a lot of benefits from the CHIPS Act to move over here and start producing. And if that really bears fruit longer term, it takes away the tail risk of China moving on Taiwan and derailing the entire global political system. So I don't know. I thought that was an interesting story. It's kind of like the nuclear 3 Mile Island story, where everyone discounts it in the short term, but in the long term, it's really huge. So you gotta give props to Biden for, we talk a lot about Trump here, but that's a really positive thing, I think, for America and global supply chains, I guess.
Yeah, where is Biden?
Yeah, I think that's super fair.
Is he still alive?
I don't know.
TBD.
I do want to talk quickly about, this is a great chart. I gotta show this slide 27. This is Bitcoin price. Speaking of macro liquidity, like we're still in this liquidity cycle. This is the seasonality Bitcoin price. The red line is price in USD, and then Bitcoin from inception to 2024 on the right hand side. And sorry, I completely butchered that. But the red is the historical price, and the black is where we are today. So the historical price, we turn up generally starting in November in Bitcoin for average returns from 2012 to 2023. So this is highly, highly bullish time of year for Bitcoin seasonality wise.
Q4 2020 is my favorite and remains my favorite macro analogy.
Yep. So we'll see if we get it.
And what moved first back then too is MicroStrategy. And there's some interesting things that are going on there right now. So it's been absolutely, like, MicroStrategy's already hitting all-time highs right now, while Bitcoin actually isn't yet. And so that's basically was the precursor last time as well, which is really interesting. So this chart, which is just basically looking at the convertibles of 2027. Dylan Clare, shout out to that guy. He's been all over this really just quantifying the MicroStrategy Michael Saylor trades, and really providing some fundamental understanding on it. So he posted this chart, just looking at basically the zero coupon convertible in 2027, and it's just been such a ride. Like literally, we were at 30%, or so basically a 70% discount to par, and now we're over like a 170 premium. And these are zero coupons, so like you're going to see this type of move. You won't see this in like a coupon yielding bond as much, but still, it just really paints the picture of where we're at. And I bring this up because I saw Quinn brought up an interesting tweet this morning that he put out, just breaking down some of the potential dynamics that we could see here coming up pretty soon, because their earnings are coming up. So I'd be curious, Quinn, if you just want to take that baton and run with and just talk a bit about what you're seeing there with MicroStrategy.
Yeah, I'll keep it short and sweet, but basically, since MicroStrategy's last convert issuance capital markets raise was mid-September, the premium of their share price to Bitcoin is up 50%. And we know, if you're following it, that the whole trade here is a financial engineering game where the implied volatility of MSTR puts a premium on the share price, and then Saylor can issue more shares or convertible notes and go buy more Bitcoin. And there's a good reason why that leads the price of Bitcoin, because it's a much slower transmission of appreciation into Bitcoin than the ETFs. You buy an ETF, create a share, and go buy Bitcoin. For MicroStrategies, it's kind of these bursts where the stock price gets bid way high, Saylor issues, it comes down relative to Bitcoin, he buys more, and it's this kind of stop start kind of step function. And right now, you're looking at a massive, massive all-time high premium to its underlying Bitcoin holdings. So his incentives are to absolutely buy as much Bitcoin, sell as many shares, or raise as much capital as possible at these levels. To do that, they have earnings next week, the 30th, after the bell. Blackout ends 1 to 2 days after. That gives a very short window between the election as to when he wants to potentially acquire Bitcoin pre-election. Because one of the things I'm thinking is, like, if there's anybody, say my base case is he has $2 to $3 billion by year end to buy in Bitcoin at these levels that he can do. And you know, if there's implied volatility options markets pricing in 10+% move in that time period, up or down, like that's hundreds of millions of dollars to get that right. Like, and for him, maybe I would be talking and paying experts on the election to try and come up with a view and things like that, and inform my decision of when I'm buying. So it's this interesting thing where if he thinks Trump's going to win, he's incentivized to slam as much purchase as he can before election, which isn't a big window. And if he thinks Kamala's going to win, he's incentivized to wait. And then if there's a dip, it gets slurped up by him. So it's this kind of thing where I just think that all roads lead to reducing the left tail of Bitcoin, because this weird idiosyncratic event that sits 1 week before the election is a super bullish catalyst. And then the other funny thing, just broadly for risk around that election week, is you have the Fed FOMC decision 2 days after. So it could just be a monumental week of like bullish news. Or if it's, let's say the market doesn't like a Kamala victory if she wins, but you have this 25 bips Fed on the other side of it. It just seems like this really interesting period. I'm excited to watch.
I had some macro thoughts, and I can't comment specifically on that specific name, but in general, one of the fascinating things that no one really realizes is, Tesla issued a lot of converts on their ARC, and everyone hated Elon. It was one of the most shorted stocks, and he kept issuing converts because he had that implied volatility, and he could issue those converts, and it was advantageous, especially when it was a ZERP world, for ramping that stock up. It gave him a long duration to have Tesla actually work. And everyone hated on him. And now it's matured. It's got all these business lines, and it's actually come to fruition. Could we be seeing the same arc? And the other thing is, Mike Milken created the junk bond market. Like, in a lot of senses, you could say, like, the different capital structures that were created from, Milken's creation created some of the coolest companies. In Tesla, you could say, was a byproduct of the fact that you can finance things differently. And it's really, really kind of a fun philosophical thought on what's going on here.
Totally. I think, like, man, you got to give respect. Like, yeah, Tesla just blew out earnings, and it's actually throwing off free cash flow now. Like, there's a lot of people that thought that would never happen.
Yeah, for a high capex product,
Yeah.
The convert market did that. And so you got to think, I wonder why if you're walking into this world where debt, now think about this. This is a big macro thought. If fixed income, fixed debt, if that becomes less desirable to hold, does the convert market go freaking bonkers? Because now you have all these implied volatility characteristics in the equity market. Why aren't more companies issuing convert debt? Because you have that, clearly buyers want it, right?
Yeah.
Clearly you get the equity kicker if, if the equity takes off on the convert bond, and it just, and you get a lower rate if you're the company. So I don't know. I think the convert market's probably going to go crazy here, just given market structure dynamics over the long term.
It's a bond with the call option. It's a perfect investment structure, if you believe in this convex right tails distribution.
Yeah, because when it's above
about.
par, it trades equity like, right?
Yeah, closer to when, yeah, and even more so as it gets closer to its strike price, which is usually 30% higher.
Right.
But like, that's something that if I as a millennial, that's more interesting to me to hedge out the inflation risk of this fiscal monetary Ponzi scheme, because you at least get some upside. A lot of these bonds actually really do well, and you get a yield attached to it.
Yeah.
Where I don't want to buy fixed, rate debt for 30 years in a government that could not even exist anymore.
The best is if you can afford to purchase a home or any asset that allows you to get a 30-year fixed term mortgage. That is one of the best, in my opinion, inflation hedges.
Well, I'm Canadian, so we don't get those things up here. So fucking must be nice.
Dude, trying to understand the Canadian housing market is like, calculus on steroids. Really How is that thing not busted yet?
Oh my God, I don't know. I really don't know, but I'm waiting. Okay, the last end of the show here, I'm doing something new. I'm calling it a FUD Buster Fridays. I got pretty fired up about this concept over the past week because for some reason, this chart on the right started to make its rounds in like the doomer bricks, like de-dollarization type of corners of macro Twitter. And it was really starting to frustrate me because it just misses like a fundamental understanding of fixed income markets. So, okay. On the right here is what we're seeing is the unrealized gains or losses on bank balance sheets, basically. And when you have these assets on your balance sheet as a bank, you can decide, you have three options of basically how to, categorize those bonds. They can be held to maturity, they can be available for sale, or actively trading them. So generally speaking for banks, it's the first two, held to maturity or available for sale, or, HTM AFS. And within that is the important distinction between it, and it's in the name, is you're going to hold one to maturity, and there's ones that are available for sale. So the big distinction here I want to hone in on is held to maturity. And basically, to explain this, we need to do like a little bit of fixed income 101 here, which is basically that, as long as you don't have to, if you own a bond and it's trading at a discount to par, so you have an unrealized loss on your book, as long as your investment horizon, as long as you plan to hold it to maturity, it will mature at par, regardless of where it's trading at that time, assuming no credit event. So regardless, as long as you just, as in the name hold it to maturity, it will, the loss will reverse itself and it'll mature at par and the loss will go away. So what we're seeing here is just basically the function of what a rate hiking cycle actually affects, which is that when rates go up, bond prices go down. But as long as you actually, hold them to maturity, which is in the name, held to maturity, it will mature at par. You won't have the loss on your book. So it's just simple mechanics of fixed income 101 being attributed here. But then people look at this and say, oh my God, we're on the verge of a new, 2008 moment. And then again, on the left here is my explanation of this, is that, okay, the only reason that they may become a forced seller is if they need liquidity because there's a bank run occurring and people are withdrawing their bank deposits and they need to match those withdrawals. So then they need to start to potentially sell this book of bonds to basically fund those withdrawal demand. So, okay, that's basically was the reason between why there was the creation of the BTFP facility a year ago, was basically so that banks didn't have to become forced sellers of these held to maturity bonds. They could just post them at the BTFP window and basically, instead of having them trade at like 70% to par or something like that, they just are like valued at par. So that is basically covering it.
The acronyms. Hey, watch the acronyms.
The acronyms, man. You gotta keep
acronym. You want here's another acronym. You want another acronym?
So this is what's so important to Charles' point, and this is my main takeaway here is do not fade the acronyms. When there's an acronym in hand that the Fed is using, it means they're covering it. So okay, as long as it just sits there, it's going to mature at par. So that doesn't matter. If a bank run occurs, the Fed's just going to turn on the BTFP again and allow them to post this, or just use the discount window, which is literally what this is like, is just like has been there for decades and is what it's there for. Obviously, they're going to be valued at their discount to par, but they're not going to have to actually sell that bond. They can just, take out a loan on it and then use that to match those withdrawals. But again, if this started to become an issue, BTFP would be up and running quicker than you can say buy the fucking dip. That's my fun buster Friday.
Here's a great framework. I love that, by the way. That was dude, your CFA, totally worth it. Totally worth it. But here's a rough dumb man's framework is if you're under the assumption that we are in a boomer Ponzi scheme, a boomer politician Ponzi scheme, none of this surprises you. The market at new all-time highs doesn't surprise you. You have pensions. The market can't go down. I shouldn't actually say that. But what I'm trying to say is like, whenever there's stress in the market, they have to paper it over because the liabilities are so huge. And so for the first 10 years of my career after 2008, I was so in the bear world. And
bear hold.
Every time I was like, the market would feel like it was cracking or there was some credit stress or something would happen, they just come and paper it over, and they have to. And so that's sort of the bottom line of what, and there's going to be a time geopolitically when that doesn't work. And I hope to be smart enough to recognize when that happens and the credit stress is real and they can't paper it over. But I don't know. You look at the history books, it's littered with fiat currencies and ruin.
Yeah. It reminds me of the meme where it's just like there's like the right curve, or sorry, the left curve of the bell curve, where he's just like year to date P&L like up 10,000%, and then there's the other guy who's like in the middle of the curve who's just like year to date up 1%, and he's like you're fucked when the music stops, and the guy with like up 10,000% is like, okay. No, we go down 30%, but I'm still up one day the can kicking will not work, but ideally you'll have ridden the wave that it, you might get a little chip in your book, but you're going to be okay.
Yeah. I feel like that's what people of this podcast listeners are like. Yeah, these young guys, they're just perma bulls. They don't. But
I'll eat some humble pie. I'll call out myself when we stop being wrong.
Also, I wish we were doing this podcast in 2021, because I bear posted for 12 months straight. I was such a bear in 2021, and it was mostly valid, but I was the opposite of how I am right now. And I will hopefully, I'm sure, be like that again one day.
When the facts change, we change, baby.
There you go.
Facts over feelings.
Yeah.
Facts over feelings. That's what we do. Great to chat with you guys again this week. A lot of fun as always.
Have a good weekend.
Later.